Welcome everyone to this webinar, 7 Mistakes That Investors Make, which doubles as a demonstration of the Finance Education for Investors course. My name's Sam Wylie. I'm going to start off by showing you a list of the 7 mistakes that we're going to discuss, and then I'll explain what I mean by demonstrating my Finance Education for Investors course. And then I'm just going to talk about myself for about a minute, and then we'll be right into it. So let's go to that. So there's a set of slides for this presentation. You can find them here at windlestone.com.au. Now, here are our 7 mistakes we're going to discuss in the webinar. And when I went to make the webinar, I wrote down about 50 mistakes, believe it or not. And here's another 7 mistakes that we could just as easily discuss in the webinar instead of these mistakes. Now, I didn't choose these 7 mistakes because they're necessarily the biggest mistakes. I chose them because they form a narrative. They naturally go together, and we can choose some fictional characters and work through the mistakes with those fictional characters, which is what we're going to do. Now, I'm also going to demonstrate my Finance Education for Investors course, and the purpose of the course is empowerment and getting to better outcomes, giving you the feeling and the actuality of empowerment in your investing and getting to better returns, higher levels of wealth, reaching your financial goals more quickly. And it has these components, and what will come out in the webinar is the investment process, investment philosophy, knowledge, and the 10-step process of self-examination, which is a really crucial part of the course. Okay, now about me. I studied engineering at the University of Western Australia, where I met my beautiful wife, Tracy. Tracy and I both moved to Canberra to work for the federal government. While working for the federal government, I studied at the ANU, a master's degree in economics. And then I won a scholarship from Solomon Brothers to go to the London Business School to study financial economics, which I did my PhD. We were there for 4.5 years in the UK. Then we went to the US, where I was a junior professor at Dartmouth University, which is an Ivy League university in New Hampshire in the US. And then in 2004, we came back to Australia, and I have been a principal fellow at the Melbourne Business School since then. I have really deep practical knowledge working with corporations and banks. Now, I also do an amount of media. I write for the Australian very occasionally, go on the ABC quite a bit, and write regularly for the Australian Financial Review. Okay, now we're going to follow a narrative here in which we're going to bring out these 7 mistakes. We're going to follow the story of Tom and Mithra. Tracy says that Tom looks a bit too old for Mithra. Well, I'm 3 years older than Tracy is, and it's worked out for us. So I think it's okay. And what we're going to do here is start off when they are a young couple and don't have very high incomes. And we're going to look at their salary and investment income. So this is their combined salaries. This is investment income from any shares they have or a rental property or the like. And we're going to look at where that salary and income goes to. Now, of course, most of it will go into spending, but the parts that don't go into spending will go into saving and into tax. And that's what we're really interested in here. We're going to follow their story and look at the mistakes that they do and don't make on their long investment journey. We'll start off when they're quite young. In the photo, they're a little bit older than the beginning of the journey. Let's start on that. So let's say that their combined salaries are 200K. One of them makes 110K and the other makes 90K. They've been into their careers for a few years. And then the first thing is that they have to make contributions to super, compulsory contributions to superannuation, 10% of their salaries. So $20,000 is going to go into super. And the federal government's going to want 15% of that, 3,000 of the 20,000, which itself is 10% of the 200,000. And then that'll go into super. And their super is slowly but surely accumulating. So this is a forced form of saving. And we'll come back to that very shortly. And then, of course, they have to pay tax. So on $200,000, they'll pay approximately $50,000 of tax between them. So then they'll have 150,000 left over down here, and they are saving a chunk of that. We're going to be very concerned with what is before tax and what is after tax. So I've colored the slide for that purpose. So they'll be saving an amount of $150,000, and they're accumulating saving, and they're really saving to buy a home. Maybe they're saving 30 or 40K. That'd be quite a lot, leaving them 110 or 120K to live on. But in any case, they are saving to buy a home. And at the moment, they are saving here, and they're also saving here. This is where they're accumulating wealth. And they haven't had to make very strong choices yet, except the choice of how much to save and how much to spend. Now, the first mistake that we can see is to do with superannuation, or the first mistake that investors make here is to do with superannuation. And especially having a retail fund instead of having an industry fund. So the retail funds are the AMPs, the MLCs, the Colonial First States, the IOOFs, etc. of the world. And the industry funds are the Australian Supers and Host Plus and Uni Supers of the world. Now let's look at some data on retail funds versus industry funds. And you can see here, this data, which is from Chant West from this month, shows the performance over the last 10 years. So that's a good length of time to make comparisons over, of growth funds in each of these types of super funds. Well, the top 8 here are all industry. Now, these are retail funds down here. This is a small retail fund, and this is a large retail fund. It's unusual for any retail funds to appear in this top 10. These guys have appeared for a few years, but usually there isn't any retail funds in this top 10. And the outperformance by the best super funds, best industry funds over the best retail funds is really large. On average, the outperformance of the industry funds over the retail funds, the Aussie Supers and Host Plus and Sun Supers and Uni Supers of the world versus the AMPs and MLCs and IOOFs and Colonial First States of the world, on average, that outperformance, as shown by the Productivity Commission report from a couple of years ago, is 2%. That's what the Productivity Commission found, 2% per year. Now, that really makes a big difference over your long investment journey. And we know where that 2% comes from. About half of it is higher fees, and the other half is the industry funds investing more in private assets, meaning infrastructure, private equity, private credit, hedge funds, real assets. Now, I'll talk more about what those things are as we go along here. And of course, in my course, all of those kind of things are completely explained. That's a part of the build-up of knowledge in the course. So first mistake, being in a retail fund, which would come about because that was the default for your employer when you first started working, or perhaps a financial advisor put you into a retail. Investors who are in retail funds should seriously think about moving to one of the best. Corporate and government funds are ordinarily pretty generous. And if you are advised to leave your corporate or government fund, and I don't mean just, you work for Woolworths and Woolworths put you into this fund or that fund. I mean, some corporations have old funds that they themselves run. That would be Qantas or Telstra, for instance. They have internally managed corporate superannuation funds. They're kind of rare. This is more common, that you work for a state or federal government or an instrumentality of state and federal government. Usually these are pretty generous. And if people are advised to move from there, especially advised by a financial advisor to move to here, then they should seek a second opinion, maybe even a third opinion, because that's been a very bad move for a lot of investors over time, from bad advice from financial advisors. But from here to here, that should be the default. Now, what about self-managed super funds? Well, there's just too many self-managed super funds. There's 600,000 self-managed super funds in Australia, and there probably should be only 200,000 self-managed super funds. Accountants have opened self-managed super funds for their clients, which has been great for those accountants, but not so good for the clients. Now, there are good reasons for having a self-managed super fund. One would be if you own commercial property that you use in your business, it's terrific to own that commercial property in your self-managed super fund. That's a kind of specialized thing. If you have very high balances, $2 million or more in your self-managed super fund between you and your partner, that might be a reason. If you want specific control over your assets, so you can do particular risk management or maybe bring some leverage to bear in your investing, then you're going to need to have a self-managed super fund to have that control. But those things are not the mainstream. Most people who have a self-managed super fund have it because their accountant told them to get one, and it's not serving them well. And they really should close their self-managed super fund, move to one of the best industry funds. And of the 600,000 self-managed super funds, maybe 200,000 are good and the other 4 should close. Okay, so those are mistakes. Now let's move on with Tom and Mithra. So Tom and Mithra are saving to buy a home, and they buy a home. They buy a home for $1 million. Depending on where you live, that'll buy more or less. Where I live in Perth, that buys quite a nice home. But if you live in the centre of Sydney or in the centre of Melbourne, it's something more modest. But in any case, they're getting rolling in their long investment and life journey. And and they buy this home with $200,000 of equity. Their super's built up a little bit. They've got $200,000 of their own money in the ownership of the home, and they've got a mortgage for $800,000. And it is a principal and interest mortgage, which makes sense. Mostly it's interest because they're early in their journey. Okay, and then we move forward a couple of years, and what's happened here is the value of their home has gone up $200,000. So they've experienced a capital gain of $200,000, and they've also paid down their mortgage by $100,000. So the equity in the home, which is the biggest part of their wealth, the super's grown a little bit, but the equity in their home, which is the biggest part of their wealth, has grown to $500,000. And now they think, maybe because they're planning or actually have started the family, or just because they're aspirational, they decide that they're going to buy a nicer home. So they use the $500,000 of equity they have here to buy a nicer home. So they sell their home and move to a $2 million home. And now they've got the equity, they've got their super, which has moved up a little bit as they're making their concessional contributions. And they've got quite a lot of debt, $1.5 million of debt. Now we want to get to the second mistake that many investors make. And it's about this. It's about paying down the principal versus making contributions to their concessional super. So there's a tension between these two. And they may not have enough money to do both. So they start to pay down, they are paying down the debt on their family home, on their main residence. And they have to decide whether when they have excess savings or when they have more money, should they put it into here as additional contributions to super, or should they put it into here by paying down their mortgage more quickly? Now, this is a decision that many investors have to make, especially early in their investment journey. Super's got terrific characteristics. So in superannuation, you don't pay very much tax. You only pay 15% on income tax. So when the shares that you own in here pay dividends, 15% tax on that. When the bonds that are owned in here pay coupons, which are interest. When the property that's owned in here pays rent, all of that kind of income, only 15% income tax, not 34 or 47%, etc. And capital gains tax, meaning that when the shares go up in value and they're sold, and tax has to be paid on that capital gain, or property that's owned in the super fund goes up in value and it's sold and capital gains have to be paid, that's only 10%. Now, this is in the accumulation phase until people reach their preservation age and can begin a pension, an account-based pension. At that point, there's no income tax and no capital gains tax once the money gets moved into the pension phase. And of course, the money can be taken out and no tax is to be paid. So this is a terrific way to save. Now, there are some things that people don't like about super. One is that you can't get your money out until you're 60. Money goes in and you can't get it out. And it's also true that they can't amplify the risk by borrowing to invest here into super. But for many people, those are not things that they're considering in any case. And so super has terrific characteristics. And a lot of investors will be thinking, I should put more money in here rather than paying down my mortgage. Now, it's not very uncommon for people to find that we bought a house, paid down the mortgage a bit, we bought another house, a nicer house, when our family circumstances changed and when our income went up and we could support a bigger mortgage, and we spent our investment journey paying down that mortgage. And now we're getting close to retirement. Retirement was over the horizon, and now it's not up close, but it's come up on the horizon. It's 10 or 15 years ago, and we don't have very much super because we spent our whole investment journey using our savings to pay down our mortgage. And it's moved us to a long way to the left on the risk spectrum, as I'll show you here. So there's a tension between making contributions here, additional contributions here, or paying money in here. Now, there's a more general idea here, which is this, that people get to the wrong level of risk. They get to a point where the amount of risk that they should be taking and the amount of risk that they are taking don't match each other. Now, here's a risk spectrum from highly conservative, meaning you don't want to take very much risk because of your personal characteristics, through to highly aggressive, high risk take. And it depends on your personal circumstances. If you have very stable income, let's say that you're a teacher or you're a doctor in a public hospital, for instance, that's going to move you more in this direction. Because you've got stability in your income, you can take more risk in your investing. If you had a risky small business, that would move you in this direction. Because you've already got a lot of risk in the making of money in your small business, this is more about wealth preservation in your investing. And then the older that you are, the less risk that you're going to take, because if something goes wrong, there's less time to adjust for that. And then you might have significant obligations in life. I don't mean ordinary familial obligations of having children and having parents, but you might have special obligations to children who have special needs, for instance. And then there's your personality, and then there's other factors. But your personal characteristics map you onto the risk spectrum. Now, this is something that we do in the course, is that as we move through the 10-step program of self-evaluation, we map you onto the risk spectrum. But it's very common when we do that for people to find the amount of risk they should be taking. Let's just imagine that that's here for this particular couple that we're thinking about, or individual we're thinking about. It's very common for people to map to one point, but then when they look at what they're actually invested in, they're mapped to another point. And the most common cause of that disjunction between how much risk they should be taking and how much risk they are taking is to do with mortgages, paying down their mortgage too quickly. Now let's just go back for a second here. And this can happen to Tom and Mithra. If Tom and Mithra, instead of increasing their contributions, see, they could make contributions of 2 times 27.5K, 2 times 27,500 each to $55,000. They could be contributing $55,000. And if they did that, if they made those extra contributions over the last 10 years, then they would be participating in these very high returns. You see here, after tax, Australian Super and Host Plus delivered nearly 11% per year over the last 11 years. And and we shouldn't expect that to be repeated. We should expect something more modest. This has been an exceptional period, but we should expect something more modest, something more like inflation plus 5% here for putting their money into super, versus about 2.3% for putting money into paying down the mortgage. Now, why do I say 2.3% here? Well, it's because if they take $1,000 of their after-tax income and pay down the mortgage with that $1,000, that means that every year after that, they'll have $23 more here. There'll be $23 less of interest payments per year if they pay down their mortgage by an extra $1,000. They'll be getting a risk-free after-tax return equal to the mortgage rate. That's what you get when you make the investment of paying down your mortgage and building up equity in the home versus investing in super. So 2.3% down here, inflation, let's say 2.5%, plus 5%, let's say 7.5% up here. Now this is risk-free and this is risky, but if you do the risk-free thing for a very long period of time, you end up a long way to the left on the risk. And this is a very common thing. And you might be thinking, or people sometimes say, yes, but if I wasn't invested in my home, if I didn't buy the home, then I wouldn't have participated in the increase in the value of, I wouldn't have participated in the skyrocketing property values. Well, they're going to participate in that anyway. This paying down the debt doesn't change the value of the home increasing, and it doesn't go to the bank. It goes to Tom and Mithra. Whether Tom and Mithra pay down their mortgage quickly or not, if the value of their home goes up, that value goes to them. If this goes to 3 million, that extra 1 million goes to them. So it's not about that. You know, they can participate in the increase in the value of their home and participate up here. And so there's a tension here, and many investors spend too much time here. And so that's our second big mistake. They get to the wrong level of risk. That their personal characteristics map them to one point, and the amount of risk they're actually taking is a different point. And the biggest single cause of that, amongst several, is that they spend too much time paying down their mortgage. Now, let's look at some other possibilities. Everyone has to think about carrying value forward into the future. And here's a way of organizing, thinking about how to do that in different structures, as I'm going to say here, different legal structures, as I put it up here. So we've been talking about Tom and Mithra building up ownership in their home. We've also been talking about them making contributions to super, before tax contributions to super. I'm going to talk about after tax contributions to super in just a moment. Another possibility is that they buy a property and negatively gear it. And I'll emphasize what negatively gearing means. I'll remind you what negative gearing means in just a moment. Or they could create a family trust, and they could put the money into the family trust and distribute the income and capital gains to different family members. And the tax benefits of this would sort of I'll introduce you to what the tax benefits and the asset protection benefits of family trusts are in just a moment. But what we'll see is that self-managed super funds are overdone in Australia. There's too many of them, and not enough people use family trusts. There's really too few of them. Or you could put money into building a business. These are really the ways forward in saving, in traveling from today into the future. So let's go through them. Let's look first of all at negative gearing, and then we'll look at non-concessional super, and then we'll look at family trusts. So we're going to start off with negative gearing. So our couple, after their incomes go up, they're making strong contributions to concessional super. You can't contribute more than $27,500 each here, but they're building up their super, and we can see that building up here. They have been paying the required amount of principal here, and the value of their house has gone up a little bit, so their equity has grown here. And they've decided to use their growing equity here to take out a mortgage with a loan to valuation ratio of 90%. They have got $900,000 of equity. They're going to have $2.3 million of debt once they buy this property and finance it mostly with debt. That gives them a loan to valuation ratio of a loan of 2.3 million divided by 3.2 million of property value. 2.3 million of debt divided by 3.2 million of property value. So about a 75% loan to valuation ratio in total, and that'll be quite feasible for them. But in any case, they have got net interest going down here. The net interest here means that they are receiving rent on the rental property, but it doesn't cover the rent after we take out expenses like agents' fees and insurance and rates, etc. Once we take those things out of the rent, then that rent doesn't cover the interest payments they have to make on the loan. And so the net interest, the interest payments on the loan minus what they receive in rent, that's what's going down here. And this is a strategy of turning pre-tax income into capital gains. What they want to happen, Tom and Mithra, is for the value of the property to go up. And we see on the course why that works. And we really unpack this on the course, how negative gearing works. All of the ins and outs of it, to do with strategy, to do with borrowing, to do with placement in the market, every component of it, a really deep understanding of this. But in any case, that's one strategy that they are thinking about, is using negative gearing. Now, one common mistake here, let's get to another mistake, is this, is for people to pay down the principal on their rental property instead of paying down the principal on their home. Now, the issue here is this. As we were talking about before, if you take $1,000 of after-tax income and pay down the mortgage here, then you will receive a risk-free after-tax return equal to the mortgage rate. It'll be $23 less per year of interest payments to make. We'll have $23 after-tax income more down here if we pay $1,000 in here. Every following year, we'll have less interest, or $23 more down here. Now, if we do the same thing up here with the rental property, it's still going to be from after-tax income. You can't use before-tax income to pay down the principal. Yes, you can use before-tax income to make the net interest payments, but this principal payment is going to come from here. Maybe I should have put it below the line, but it's easier to understand it. And I'll just emphasize that the paying down of the principal here is coming from after-tax income. Now, that means that we'll use after-tax income here, but the return we get up here is before tax. It's a reduction of this interest, which is before tax, whereas this is a reduction of this interest, which is after tax. So this is a before tax return of 2.3%, And this is an after-tax. It's a no-brainer that this is better than this. And most investors will want to have an interest-only mortgage up here. Now, there's some reasons why they might want to have a principal-only mortgage, but for most investors, a interest-only mortgage is what they're going to want up here. Now, doesn't that mean that the mortgage rate, the interest rate will be a little bit more? Yes, it'll be 20 or 30 basis points, 0.2 to 0.3% more. But in general, this is going to make this, it's the fact that you are getting after-tax return instead of before-tax return significantly outweighs that extra mortgage cost. So here's our third mistake: not maintaining leverage in negative gearing and paying down the mortgage in a negatively geared property. I mean, there's two reasons it's bad. You could have done this instead. The second thing is paying down the debt turns a negatively geared property into a positively geared property. And in general, you're going to want a positively geared property owned in a family trust, which we're coming to in just a moment. Okay, here's another possibility to use additional savings. So our couple are building up their super with concessional contributions. They're building equity in their home, and they're building equity here through capital gain rather than the paying down of principal, by the value of the property going up. Now, if they have extra savings, what they could do with that is make additional contributions to super, non-concessional contributions. So this is from after tax, so it's not as good as up here. After tax dollars are obviously more valuable to us than before tax dollars because of the tax going out to the federal government. So it's using more valuable after tax dollars, but there's no contribution tax. You know, for investors who have incomes, taxable incomes of more than $250,000, this contributions tax is 30% rather than 15%. That's regulation 293 in the tax code. But in any case, they could make contributions from after tax and really build up a lot of super. A lot of people who want to keep their circumstances simple, this is what they do. They pay down the mortgage on their home. They pay down the mortgage on their home and they build up their super through concessional contributions and non-concessional. They're not worried about the fact they can't get the money back until they retire. They're not worried about the fact that they can't bring leverage to bear in super. I mean, there are ways of doing that in the self-managed super fund, but in general, it's not easy. They're not worried about those things. What they want is the high returns that they can get in super, after-tax returns, and they want simplicity. They want a simple plan that they can execute over a long period of time and they can get on with their lives. And that's perfectly good. And a lot of people do that. After considering the other opportunities, they go with this simple plan. Now, the next thing I want to talk about is, I'll just jump forward and we'll see, that I want to talk about is gifts to a family trust. So the great virtue of family trusts, there's several virtues. It's not all about tax, and it can't be all about tax. If it was all about tax, then the ATO, the Australian Tax Office, would be unhappy about it. It can't be principally or all about tax. But there are other benefits: income protection, estate planning through your will, are other benefits of the family trust. And there'll be other considerations, and we talk about that a lot in the course. Asset protection in case you get sued. Most people don't get sued, but it's an important consideration. But also passing on wealth to your children and grandchildren, that's a very important consideration. Now, but tax is also an important consideration. And the main tax benefit here is that if you hold assets in your family trust, let's say you own shares in your family trust, or you own a rental property, a high-yielding rental property, like an apartment in your family trust, then when the income comes out, dividends on shares or the rent on the apartment, or maybe you own some commercial property in there, or the rent on the commercial property, when that income comes out, you can distribute it to any of the beneficiaries. It's entirely up to the trustee. These are called discretionary trusts, but it's entirely up to the discretion of the trustee as to who this goes to. And of course, Mithra and Tom will be the trustees. And they might have a corporate trustee, and we'll explain that entirely. Everything about this will be explained in my Finance Education for Investors course, is explained in that course. But in any case, Mithra and Tom are the trustees, and they decide where the income and the capital gains go. Now, when the children beyond the age of 18, but before making a lot of money themselves, and that's usually a long period of time, 10 to 12 years is very common, then the money can be sent to them and they don't pay very much tax. And then the money's within the family, and the money can be gifted from the children to the parents. That's the most common thing in the world. When Mithra and Tom themselves are retired, then they'll be able to receive the income without paying very much tax, because they'll be on low incomes. They might have parents who are retired. Those parents might live overseas, and the distributions can be made to them. Now, if there's nobody ready to receive the distributions and pay a low income tax, low capital gains tax, then it can be stored in a bucket company. That's what a corporate beneficiary is, a bucket company. It's a bucket that fills up with the income and corporate tax credits, something we'll talk about in the course, but that fills up with dividends and franking credits and with other income. So the bucket fills up, and then when the kids turn 18, the bucket's drained back into the family trust and to the children. Or when Mithra and Tom retire, the bucket is drained and paid out to them when they have a low incidence of tax. And this is a very powerful mechanism for long-term planning to pay less tax on income and to accumulate wealth more quickly. And it's very common. There's 450,000 family trusts in Australia. It's the most common thing in the world. Really, there should be more of them. More families should employ them for their asset protection, for their estate planning, for their tax plan. Now let's just go back here for a second, and let me show you what I mean. So let's say that we buy 1,000 shares. Let's think about where we're holding those shares. We might hold them directly in Tom and Mithra's name. So they have the direct title over the shares, and they have to pay the tax directly. Now, the dividends that are coming out in the first year, the second year, the third year, the fourth year, the fifth year, we should expect them to grow over time. With corporate tax credits attached, franking credits, corporate tax credits, dividend imputation credits, those three things are all the same thing. For some reason in finance, everything has to have three names. So shares, stocks, equities, exactly the same thing. So net profits, net income, earnings, exactly the same thing. So franking credits, corporate tax credits, dividend imputation credits, exactly the same thing. In the course, I use those terms interchangeably, which is a little bit confusing to begin with, but actually in the end, it's very empowering. It's very empowering to have facility with those terms. And that's what happens over the 10 weeks of the course, is you gain facility because we use the terms interchangeably. Eventually, you yourself use them interchangeably and you don't even notice. So having that facility with these terms really helps you to get through the impenetrability of financial language. That's one of the disempowering things that we get rid of in the course. So in any case, the dividends are paid out, as a shareholder, your share of the profits of the company, and also credit for corporate tax already paid. Dividend, credit for corporate tax already paid. Now, in the combination of these two things, investors have to pay income tax. By now, Tom and Mithra are on the highest level of income tax, but they get credit for corporate tax already paid. So on the $80, the combination of the dividend and the franking credit, the corporate tax credit, they have to pay income tax, they get credit, $13.60 gets sent to the federal government, to the ATO. Now let's think about what would happen if those shares instead were held in your superannuation fund and you were younger than 60 and in your accumulation phase, and the shares are held in your accumulation account. So the $80, you only have to pay 15% tax because tax is lower in superannuation. You get the 30% credit. So now this is obviously a negative number, minus $12. So you get a refund from the tax office. So you'll get the $56 in cash plus a refund of $12. So you'll have $68 in cash. And if the shares were held when you're in the pension phase of superannuation, then you don't owe any tax and you'll get all of the corporate tax refunded. You'll get the whole $80 here. This will be refunded. You get a check for $24 from from the federal government. So you can see how useful it is to have the money in superannuation here. Now, what about if it's held in a family trust? Well, it just depends on who we can distribute it to. If we can distribute it to children when they're still in education, at university or at TAFE or whatever their vocational journey is, when they have low incomes or after the age of 18, this might be zero, in which case this is exactly what happens. Instead of the money being locked up in super, it's immediately accessible because it's being paid out. So if the dividends are distributed to a family member who has zero incidence of tax, that might be the children, it might be Tom and Mithra when Tom and Mithra are retired, or they have low incidence of tax, then there's just going to be a lot more cash. They'll actually get refunds instead of having to pay tax. And if there's no one to distribute it to, then they're going to put it into the bucket company until there is someone ready to distribute it to. Now, I should just point out here that this is the level of mathematics in the course. The course really doesn't have very much mathematics in it at all. There's hardly any equations in the course, but because we just don't need them. We just work through diagrams and through logic. We just work through narratives and bring out all the important ideas like we are doing here. And we don't need any fancy mathematics. And to the extent that the equations do appear, which is pretty rare, then they're like that. It's arithmetic. If you haven't done any mathematics since you were in high school, don't worry about it. You'll be perfectly fine. It'll be perfectly straightforward. Okay, so let's go forward here. Another mistake that is made is the underuse of family trusts. Not using a family trust where it could help greatly. That's our fourth mistake. Now, the next thing I want to do is to talk about investment strategy. And then I want to embed investment strategy into investment process. And then we'll go on to our sixth, our fifth mistake will come out here, and then our sixth and seventh mistakes will come out after that. Okay, now strategy is always about position, about positioning yourself in the market. And so if we were talking about corporate strategy, it'd be where are we going to locate geographically? Where is our customer base going to be geographically? Where are we going to position ourselves in demographics? Are we going to go after a young demographic, an old demographic, something in between female or male or et cetera? Where are we going to be on a price point? Where are we going to position ourselves relative in quality to our competitors, et cetera? Strategy is always about positioning. That's strategy 101, literally strategy 101 is that it's about positioning. Well, it is an investment strategy as well, that positioning is at the core of it. And here the positioning means what we're going to invest in. It means asset allocation. So how much of our wealth, our investable wealth, outside of the family home or supported by borrowing against equity in the family, how much of that are we going to put into Australian shares, into global shares, into residential real estate, apartments and houses, commercial real estate, office towers or industrial parks or shopping centres? How much into fixed income, government bonds, corporate bonds, bank bonds? If you don't know what those are, don't worry about it. That's the kind of knowledge that comes out in the course. Into infrastructure, which means the shared assets, productive assets of the economy, roads and ports and electricity networks and cloud computing centres and the like. That's a fantastic asset class in these times of rising inflation. Private equity, shares in companies, whether they're small startup companies like venture capital or whether they're the existing larger companies, but private companies, shares in companies that are not listed on the stock market, not listed on the Australian Securities Exchange in Sydney, not listed on the New York Stock Exchange, the London Stock Exchange, the Shenzhen Stock Exchange, the Mumbai Stock Exchange, the Tokyo Stock Exchange, that they are privately held. Hedge funds, we can talk about in a bit, but they're a part of private assets, private credit, real assets like farms and forestry and the like. So investors have to decide how much of their money are they going to allocate across these different asset classes. Now, they also need to make allocations or position themselves within assets. So if you decide, for instance, that we're going to invest in, and so when Tom and Mithra were thinking we're going to have a negatively geared property, then they had to consider how are they going to position themselves within residential property. So they're going to buy that $1 million house, presumably they're going to buy that $1 million house and negatively gear it. So they had to think, okay, are we going to go for a remote location like Port Hedland or Alice Springs? Maybe not. Are we going to go for a regional location like Mackay in Queensland or Wollongong or Bendigo, etc.? Are we going to go for one of the cities to invest in? And then in the city, are we going to go for apartments, or are we going to go for a house? Are we going to go for a leafy suburb in the inner part of the city, or are we going to go for an expanding outer suburb? So even within the asset class of residential property, we need to position ourselves. And that's true of all of these asset classes. And that positioning, this is the what of investing. What are we going to invest in? Mostly so far with Tom and Mithra, we've been talking about the where of investing. Where are we going to hold the assets? Are we going to hold the money, our investments in super, in a family trust, in direct title, which means building up equity in our home or direct title over a rental property, etc. So where are we going to hold it? And then a third consideration is, how are we going to manage risk? How much risk are we going to bring in by borrowing to invest, usually in real estate, but possibly in shares? That's a kind of risky thing to do, but makes sense for people who are a long way to the right on the risk spectrum. How much risk are we going to bring in? And then how are we going to manage risk? Insurance is risk out, making sure that you don't leave obligations behind for other people if the worst thing happens in terms of life insurance. Hedging of risk as well. And of course, at the moment, we're looking at inflation exposure. But risk in and risk out. And we have these three things going on in strategy: where to hold the assets, in what structures, and with tax planning, what to actually invest in, and then how to manage risk. And so far, we've been talking about the where part in discussing the Mithra and Tom's circumstances. Where are we going to hold it? In super, are we going to accumulate equity in the family home? Are we going to have a negatively geared property? Are we going to hold the assets in the family trust? And we haven't been talking about what are they going to invest in. We have to a certain extent with property, but we haven't talked about whether they're going to invest in Aussie shares, global shares, commercial real estate, infrastructure, etc. here or down here. But that's a very important consideration. And then the second thing is that we didn't really discuss how much extra leverage over here. We did talk about a loan to valuation ratio combined here of 75%. But in general, we haven't talked about borrowing to invest. And we also haven't talked about taking risk out with insurance as opposed to bringing risk in by borrowing to invest. But these three things need to be considered together. That's what strategy is in terms of investing, is thinking about the what of investing, the where of investing, and the how of managing risk. What to invest in, where to hold the assets, and how to manage risk. And it's not in that sequence. We don't think of this and then that and then that. They have to be thought about together. A strategy has to be put together where these things are thought about together and they all match one another. Now, a big mistake that investors make in terms of what to invest in is that they don't achieve enough diversification, is that they might only be invested in real estate, equity in their home, equity in negatively geared property, and maybe some Australian shares in a self-managed super. And they're not diversified across these other asset classes. So they don't have anything in global shares, US shares or Japanese shares or emerging market shares, etc. They don't have anything in infrastructure or private equity. They don't have any bonds, hybrid notes, etc. And they're not diversified. And diversification is a very helpful thing. Diversification gives you something for nothing. Diversification is putting things together that don't move in perfect lockstep, that move against each other. Just to take a simple example here, diversification within an asset class in Australian shares. So you might own shares in Qantas and in Woodside, just to take a very simple example. And when the oil price goes up, that's bad for Qantas and good for Woodside. And when the oil price goes down, that's good for Qantas and bad for Woodside, because they're an airline and this is an energy. And so whether it goes up or goes down, some of that risk is eliminated by putting those two assets, those two shares together in our Australian share portfolio that move against it. And asset classes in general don't move in perfect lockstep. Australian shares and global shares and property and bonds and infrastructure, etc., don't move in perfect lockstep. Some risk is eliminated when you put those asset classes together. And people don't pay enough attention to diversification. Industry funds are a great way of achieving diversification. Okay, let's go on a bit here. And here I'm just listing the private asset classes to bring out a little bit, but really we discuss them at length, all of these things at length. As part of the building up of knowledge that takes place in the course. Okay, now, as I was saying, these three things have to go together. Where are we going to hold the assets? What are we going to invest in? Shares or property or bonds or infrastructure, etc. And how are we going to manage risk? How much debt are we going to bring in? How are we going to take debt out with insurance and hedging? So the what to invest in, the where to hold it, the how to manage risk. Those three things have to be considered together. And here's a few examples of thinking about them together. So we might buy a rental apartment. You might buy an apartment. Let's say someone bought an apartment off the plan for reasons you would do that. We'll talk about mostly to do with depreciation that we'll talk about in the course. But in any case, say you bought a rental apartment and it might have a yield of 4.6%, meaning that if it cost $1 million, then you get $46,000 rent per year. That's what I mean by a yield of 4.6% total rent. $1 million would be a lot for an apartment. But in any case, a yield of 4.6% after outgoings like insurance and rates and agents' fees, etc. If you use an agent, there might be 3.6% here, for instance. It would be the 3.6% at the moment would be more than you would pay on the debt. So this is going to be positively geared. The rental payments are going to exceed the interest payments. And this is going to generate cash. And if it's generating cash, we want it in a structure where we can distribute that cash to a family member who has a low incidence of tax, even if we have to store that income in the bucket company for a period of time. And we don't need a lot of debt here. We can choose a level of debt, but we don't need a lot of debt. This isn't really about turning pre-tax income. We don't need a lot of debt because we don't need to make it negatively geared. So these three things go together. Whereas if we were talking about a rental house, let's say in a leafy suburb that has a low rental yield, let's say the rental yield after outgoings, the insurance, the rates, the agent, etc. Let's say that that's 1.5 to 1.7%. And the reason that we're accepting a low rental yield is because we're expecting a lot of capital gain. And if you want more capital gain, then you've got to accept a lower yield. So we have a low rental yield. It doesn't cover the interest payments. It has a negative cash flow. And we put those losses against our salary income. And the only way to do that is to own it directly. If this was owned in the family trust, then there'd be no way to put the losses of the rent being less than the interest payment alongside or use it to reduce our taxable income. There'd be no way to do that. So we have to hold it in direct ownership. And we want to maximize those losses by having as much debt as possible here. In general, we want to maximize those losses because we want to turn pre-tax income, which are used to support those losses, into capital gains in the strategy that is negative gearing. So these three things naturally go together once we think it through. The what, the where, and the how have to match each other. And down here, you might be invested in high-yielding Aussie shares that pay a lot of dividends relative to their price, like BHP or National Australia Bank. High-yielding Australian shares are going to throw off a lot of income, so we want them in the family trust so we can distribute the income to family members who have a low incidence of tax. We don't want to have a lot of debt. This might be zero. Now, we might have some debt. We might have some borrowing to amplify risk or not. Depends on where we are in the risk spectrum. We'll have to match that to our circumstances that put us onto the risk spectrum. But we'll think that through. We'll think through the what, the where, and the how, and combine them to get to the strategy that we want. This is what investment strategy is. Now, we want to think about investment strategy as just one part of investment process. Investment process is the bigger thing here. It's an investment process that you need to carry forward through time and to enact through time. And it's an investment process that we get to in the course. I explain what the investment process is, and then we bring you up to speed on the investment process with a 10-step program of self-evaluation of your investing. And week by week, we bring you up to speed on an investment process so that by the end of the course, you have a good, well-functioning investment process to carry forward. So our investment process has these components. We need to set goals for the future. Now we need to jump back to the present and think about where we should be on the risk spectrum, and then look at whether the risk that we're currently taking, whether that matches the risk that we should be taking. And if it doesn't, do something about it today. And most people will find that there's some disjunct that needs to be sorted out between the risk they should be taking on the basis of personal characteristics, mapping them onto the risk spectrum, and the amount of risk they are taking, what they're currently invested in. And then we need a strategy to go forward in time. The what, the where, the what to invest in, the where to hold it, the how to manage risk, and also implementation, which I'll come to in just a moment. And then we need control of the process. You need to check from time to time, am I on track to reach my goals? Am I saving enough to reach my goals? Do I know where the money's going? That's financial control. Do I want to hand over control of this whole process to somebody else? That's what financial advice is them taking control of your investment strategy and your investment process. So strategy is a part of a bigger thing, investment process, but it's right at the heart of it. And it has these components, the what, the where, the how, and implementation. Now we can think about it in these terms. So it begins with the setting of goals, the writing down of your goals. Most people have never written down their goals. I bet you've never written down what your financial goals are, but it's absolutely essential to do that. And for most people, it comes down to these things. It comes down to property for themselves, buying a main residence, a family home that suits the lifestyle that they want to have, and later on helping their children to launch in the property market, especially in high-priced property markets like Melbourne and Sydney. So it comes down to property. It comes down to education of children and of grandchildren. It comes down to having enough money in retirement to be comfortable in the long part of the journey that is retirement, but also to have enough money at an advanced age for aged care, and then to fulfill other requirements in the living of a good life. In any case, to meet our goals, we need to make choices. And the first choice is how much money to save. Tom and Mithra had to make that decision all the way through. And then the second choice is the what of investment. What are we going to invest in here? And I've expanded that out into our asset classes again here. The reason I put a line through hedge funds here is it's not that hedge funds are a bad thing to invest in. It's just that you need to do it through someone who can choose the best hedge funds. If you try to go directly to hedge funds through a financial advisor, for instance, or through a managed fund, we'll talk about what managed funds are in the course, then you'll just end up with the hedge funds that wealthier investors didn't want, that the billionaire investors and the very wealthy investors, and also that the big super funds didn't want. That's what you'll end up with. You pay high fees and you'll end up with the dross that's left over. So if you're going to invest in hedge funds, do it through someone who has a really expert investment team and gets a crack at the best hedge funds first of all, like Aussie Super, for instance. So in any case, asset allocation, this is the what of investing. This choice has to be made. And in my example here, our investor, let's say they've got $1 million to invest. I know $1 million is a lot of money, but let's say they have $1 million to invest outside the ownership of their home, in super, in a family trust, direct ownership, etc. And they decide to put 250,000 into Aussie shares and 300,000 into global shares. And here what I mean is they buy a property worth 750 and they finance it with 500,000 of debt. So their equity is 250,000, but their exposure is 750. And that's an important distinction that we work through when we start looking at what you're currently invested in, what you should be invested in. And then infrastructure and private equity and cash and the like here. So what to invest in, how much risk to bring in, how much to take out, the how of investing. And then the where of investing is down here. You can see why I've stacked up these choices in this way. And they also need to think about implementation and control, handing over control to somebody else, which I'll come to in just a moment. But here we have the risk spectrum. Do your personal characteristics put you where you should be taking a low amount of risk or where you should be taking a higher amount of risk? You have to decide that early. It's the next thing after setting of goals is to position you on the risk spectrum, because this drives these things. If you're down here, low risk, then most of your money is going to have to be in the defensive asset classes of fixed income and cash. And if you're up here, high risk, then most of your asset allocation is going to have to be you're going to want to be in the high risk, high return asset classes of shares and property. And you're also going to amplify the risk, gear up the risk, leverage the risk. You can see what I mean by everything having three names. Leverage, gear up, amplify the risk here to get to the right point on the risk spectrum. And then, you're going to want to take risk out as well through insurance. So this drives these things. So it's important to get it right straight away. So we need to set goals, position on the risk spectrum, start making choices as part of in the investment process. Asset allocation is a crucial choice, but other choices are crucial as well. It's not just about the what to invest in. It's about the where, the how, and implementation as well. And also about whether you want to hand over control to a financial advisor. Now, financial goals come out of life goals. Money, after all, is our servant and not our master. And people find that in setting financial goals, they have to think about their life goals, and they haven't really done enough of that through time. So it often ends up being a very helpful process on many levels. Now, let me just say something about implementation. So we have the what, the where, the how of investing, but then it has to be implemented. We might be thinking we're going to invest in Aussie shares in our family trust, and we're not going to borrow any money to do that. Or maybe we're investing in Aussie shares in our self-managed super fund, and we're not going to borrow any money. Or maybe we are going to borrow some money for the family trust. Either way, it then has to be implemented. None of that is about implementation. By implementation, I mean to implement that decision to buy Aussie shares in the trust is to open a brokerage account, for instance, and then to invest in exchange-traded funds or in managed funds, or maybe invest directly in shares or in listed investment companies. Now, if you don't know what those things are, well, then take my investments course, because that's just part of the building up of knowledge. We build up knowledge to understand how to implement, to actually go the full distance after thinking through the strategy, the what, the where, and the how, to actually implement the strategy, to buy and own the shares, whether to do that through a broker, a full-service broker, whether to do it through a discount broker, whether you want to use managed funds or exchange-traded funds, etc., as I said. Which of those choices is best for you, and how would you actually do it anyway? That's what implementation is. Look, I mean, my course is all about impact. And if I don't take you the full distance in explaining how to do these things, how to implement investment process, and especially investment strategy here, if I don't take you the full distance, then it won't have any impact. If at the end of the course you think, wow, that was really interesting, and Sam's a kind of funny guy, well, that'll be good, but that won't, in 5 years' time, you will have forgotten all about that. It'll be about, did it give you the feeling of empowerment? Did it change your investing? Did it get you to better outcomes or put you on a path to much better outcomes? And implementation is so important in that. Okay, now the final thing here in this part is that when you make choices, you need a set of guiding principles to compare those choices to. And that's what investment philosophy is. It's a set of principles that throughout your whole investment journey, you compare your choices to. And we develop an investment philosophy in the course, as you'll see in just a bit. Okay, so the course is all about empowerment and getting to better outcomes, higher returns, higher levels of wealth, getting to your financial goals more quickly, the feeling and actuality of knowing what all the parts of investing are and how to act and who you can bring in to help you with that. And then we have these components. Investment process is the most important part. This is our set of guiding principles. This is the knowledge that we need for implementation. And this is bringing you up to speed on the investment process. This is finding out what's right and wrong about your investments week by week, working through 10 steps, finding out what's wrong and what's right about your investing, and bringing you up to speed on the investment process. Because if I just describe the investment process, it'll be like a train going by and you won't be on it. You need to be brought up to speed on that investment process over the 10 weeks of the course. Now, the materials and the way that we actually bring that about is that we have 10 2-hour live classes. So these are Zoom sessions It's not a webinar. You can turn your camera on or not turn your camera on, either is good. But you can definitely turn your microphone on and ask questions. And there's a lot of that, a lot of sort of direct discussion here. If you don't get to the live class, you can watch it video on demand. And so these videos are released at the end of the class for the next week, and they're released as we go along. There's a lot of supplementary videos. There's a set of 10 30-minute videos, one for each week, that are supplementary, that are not discussed in the class, that you watch separately to the class. And those 10 videos are between Brendan Gilly and me. Brendan's a former student of mine who owns an accounting firm named Pryor Gilly, former student at the Melbourne Business School. And he and I, in these 10 videos, talk through superannuation in 2 videos, and then we talk through family trusts in 2 videos, and then we talk through all types of tax in 2 videos, and then we talk through borrowing to invest in 2 videos, and then in the last 2 videos, we talk through what to do if you want to go from being an employee to being a contractor, and then in the very final video, we talk about wills and estate planning. But people find those videos exceptionally helpful, and they're supplementary to the course. There are a series of 10 videos that are available on our learning management system. So we use a web-based learning management system where you can watch all the videos, where all the videos are stacked up, and all the other materials, such as the PowerPoint slides, are stacked up. It's very easy to log in. It's very nicely presented. This is a software product from a company called Thinkific, which is 4 courses like this. It presents all the materials, makes it very easy for you to track your progress, etc. You would have seen learning management systems in the past, and presumably, and you'll find this one very helpful. And then finally, people speak to me one-on-one during the course. And we discuss investment journey, your investment journey. You ask me any questions that you have about the course. Not everyone wants to do that. Some people worry that it's Sam checking up on whether I've done my homework or not. And they don't want to discuss anything personal. And, I respect that entirely. But it's actually not either of those things. It's just an opportunity to talk through your investment journey and to ask questions related to the course. Okay, so they're the materials that support the content, where the content delivers on the purpose. Now, let's come back to our 6th and 7th things that are wrong. And so now we want to talk about life insurance. And the thing that people get wrong about life insurance is that they often don't have enough life insurance when they need it the most, when they have large obligations because children are young. If they have children, then children are young and they have big obligations. Life insurance is all about meeting obligations if the worst thing happens. And their obligations are large. They don't have the resources to meet those obligations. They need insurance. And insurance is low in cost. So the difference between the benefit and the cost of insurance when people are younger is large. And they often don't have enough insurance when they're younger, and then they end up with too much insurance when they're older, because the need for insurance, children get older and eventually launched. Although that takes a while. We have 3 young adult children. It's true for everyone. It takes a while to get children launched. So, but in any case, obligations go down. Ability to meet those obligations because wealth is accumulated goes up. So the benefit of insurance goes down. And as you get older, the cost of super goes. Too many people end up out here where cost exceeds the benefit, but they've still got a lot of insurance. So having the right amount for your age, really important thing. You don't want to have too little when you really need it and too much when you don't need it as much. Now, our 7th issue is a mistake is about advice. People getting the right type of advice. Now, in our course, we have 3 narratives that run all the way through the course. So we have Ravi and Jess, we have Brooke, so we have a young couple, we have a middle-aged single who's a lawyer at the Attorney General's Department in Canberra, and we have an older couple who've accumulated a significant amount of wealth. And all of them are pretty good in terms of their financial advice. So Ravi and Jess don't have a financial advisor, and they're not very engaged with their investments. It's really about building their super and paying down their home. Jess has a business, which they're pumping money into, which adds some complexity. But it's really that they have a simple strategy. They're not very engaged because they've got young children and they've just got a lot going on in their lives, but they keep it super simple. They keep it super simple. They're not very engaged. It's okay. Now, Brooke has more complexity. Brooke has a family trust, and she also has a rental property and a few other things going on, but that's the main parts of the complexity. She has a more complex situation, but she's very engaged in her investing. So she doesn't need a financial advisor either. And David and Beck have got a even more complex situation, a self-managed super fund and a family trust. And Beck has only recently sold her business, a veterinarian business, etc. More complexity. They don't want a high level of engagement. They've been working very hard for a long time. They want someone else to take care of it for them. And so they do have a financial advisor. They have passed the control to somebody else. So all of these make sense. All of them are are good decisions given where they are. What you don't want, and what is a mistake, is to be here. If Ravi and Jess were here, they would be paying a lot for something that they don't need, way too much for something that they don't need. And you don't want to be here either. If David and Beck, if Beck and David didn't have a financial advisor and they weren't engaged, then there'd just be a failure to implement. Things wouldn't work out well at all. I mean, a lot of self-managed super funds are like this, where people have been set up with a self-managed super fund by their accountant, but now no one is actually running it. And the money flows in through non-concessional and concessional contributions. Money flows in, but it just goes into cash and there's no implementation. And so this is a failure to implement is something to avoid as well. So mistake number 7, the wrong level of advice. A financial advisor for simple circumstances is not needed and is just unnecessary fees. No advice when you've got a complex situation and low engagement means a failure to implement. Both of those. Okay, now let me just tell you a bit more about the course and then we'll wind this up. So I'm going to go into each of these things and just talk about them briefly to give you a better understanding of the course. So the first part here is investment philosophy. So we have a low-cost value investment philosophy. Value here means value versus growth. I'm not just repeating myself. Value versus growth. Value philosophy is the philosophy of Warren Buffett and many other very successful investors. And I'll explain what the evidence for value investing versus growth investing is when we get to that. We come to really understand the sources of value, what it is that investors get compensated for. This is extremely helpful in avoiding making poor decisions. And you'll see if you take the course why it's so important to understand sources of value and to be able to compare opportunities to them. There's a big emphasis on diversification because diversification is something for nothing. Sometimes people don't like diversification and they say, if you really had strong conviction, if you knew what was going to go up in value, then you'd have strong conviction and you'd just invest in that. Well, of course I would. If I knew which horse was going to win the Melbourne Cup, I'd put all my money on that horse. You don't know what's going to happen in the future. And what those people are getting confused about, I think, is about making money and about investing. Now, in making money, in your business or in your profession, you have to be specialized. That's the opposite of diversification. If you've got a business, you've got to work out what your market is and just concentrate on that and absolutely go for it. Remember, the strategy is always about positioning. You've got to position yourself tightly in the market and absolutely go for it. And that is the opposite of diversification. And it's true if you're in the profession as well. In your work, you need to have a concentrated set of skills, or you need to have focus on what you're really good at and be super good at that and get continually better and better at it. It's the opposite of diversification in making. But in investing money, diversification is you only move away from it if there's a very good reason for doing that. And we'll talk about some of those reasons and circumstances in the course. I think that's a very common misunderstanding. The need to minimize transaction costs and fees, you'll see how really important this is and what a huge difference it makes in the course. Getting expert advice, not simply getting people who are pretending to be experts, paying them large amounts of money or paying simply for hand-holding, but really expert advice, and who are expert and who are not expert. That's something that comes out in the knowledge of the course, where we talk a lot about financial advisors and accountants and mortgage brokers and insurance brokers, etc., and sort out what defines who's expert and who's not. Avoiding complexity. Complexity is not your friend. You know, I mean, again, there's a sort of a misunderstanding here between making money and investing money. You know, in making money, complexity is your friend. If you own a business or in the professions, if you're doing something that's not very complex, expect an immense amount of competition. If it hasn't arrived yet, it's coming. If you do something that's not very complex, you'll face a huge amount of competition. And to move away from that competition, in the 21st century, you've got to do more and more complex things. Complexity is your friend in making money, and move towards it, embrace it, and help other people with it to create value. But in investing money, complexity is not your friend. It's a great way to hide fees. It's a great way to hide risk. If you look at an investment and you think, wow, I can't see where the risk has gone here, you've got it. It's just a brilliant way to hide risk and fees. And it's hardly ever helps. Now, it does help with hybrid notes. And hybrid notes really have got something going for them. If you don't know what hybrid notes are, which you probably don't worry about it. I'm going to unpack them completely. Ordinarily, I'll encourage you through the investment philosophy to ignore complexity. But in the case of hybrid notes, really just we unpack them in the course, because hybrid notes have got a lot going for them. And evidence-based decision-making. Okay, so that's investment philosophy. And now let's just look at the 10-step self-examination here. And you'll see that this is the 10-step program of self-evaluation. And we move through from setting goals, writing down goals, to positioning you on the risk spectrum, to looking for a disjunction between where you are on the risk spectrum and what you're actually invested in today. We talked about this disjunction earlier, and the biggest cause of it being that people spend too much of their investment journey paying down their mortgage. That's a very common thing. And then we want to go to control and checking whether we're saving enough. I give you a calculator for this purpose. Am I saving enough to reach my goals? Most people reach the happy conclusion that they are, which is good. But if you're not, then what to do about it? Where does the money go? This is financial control. Most people who earn a lot of money, but when they retire don't have very much money, can't tell you where the money went. And so I know this sounds a very banal thing to talk about financial control and the kind of apps that will help you to understand better where the money goes in your spending, not in your saving, but in your spending. But it's essential. And you can get to much better outcomes. You know, you can have as much sort of happiness or benefit from less money if you understand better where the money is going. So then we move up into strategy. So this is the where, this is the what, this is the how. This is actually a combination of the how, and this is implementation. And week by week, we go through those things, looking at where you are and working out where you should be on those things. And then we talk a lot about financial advice as well, which is handing over control to somebody else. So this is what I mean by bringing you up to speed on investment process, is that week by week, we go through the components of investment process and see where you're at with it and work through. Now, we don't actually do that in the class. I give you everything, including all of the materials and the examples to do that for yourself. And you do that between the classes, because in the class, we're talking about, we have a lot to talk about. And a lot of that's knowledge that we need, especially for implementation, knowledge about the different asset classes and what they are, knowledge about historical returns, what you should expect in the future in terms of how quickly your wealth will grow if you invest in different things and how risky they are, different types of products like mortgage products and exchange traded funds and managed funds, etc. Different types of superannuation, etc. The different participants, advisors and brokers and companies and platforms and accountants and the like. The where of investing. And this is the 10. This is the 10 series. This is the 10 video series with Brendan Gilly, and about taxes and about finance fundamentals. You know, there's very little overlap between my courses at the Melbourne Business School and this course, but they're all built on finance fundamentals. So finance fundamentals come out in this. I should just mention that the course really starts at the beginning. It doesn't assume that you know anything about finance. It's a challenge to bring people who know nothing about finance along quickly, starting from the beginning, assuming they know nothing, and bring them along quickly, and keep people who already know a bit or a lot about investing engaged as we bring everyone up to speed. Bringing people up to speed and keeping other people engaged at the same time But that's the challenge you always face at business school. And if you get to be a good business school professor, then you need to be able to solve that challenge. I won the teaching award at the Melbourne Business School 12 times, more than anyone ever. I know it's highly immodest to say that, but I think it's okay. Okay, let's go on. Probably I shouldn't have said that, but let's go on. Here I'm just looking at some of that information that we developed, some of the knowledge. These are this is an explanation of why you need to go overseas to invest in global stocks to achieve diversification, because Aussie shares are very concentrated in miners and in banks. And to get to tech and manufacturing and pharmaceuticals and the like, you need to go to global shares. This is looking at self-managed super funds and asset allocation, bringing out lots of building up understanding about self-managed super funds. This is about implementation of investments in shares. This is about how the advice networks work. This is about how family trusts work and working through long examples to really bring out every part of to do with family trusts. This is about negative gearing strategy. And I know I'm not explaining this slide. I'm really just showing you that we have high quality dynamic graphics to bring everything out. This is about hybrid notes, etc. Now, the next thing is that we have a lot of narratives, or we have 3 narratives that run all the way through the course. We have other smaller narratives, shorter narratives, but we have 3 main narratives that run all the way through the course. A young couple, Ravi and Jess, and then a single in her mid-40s, Brooke, and then an older couple who are just retired, Beck and David. And we follow those 3 narratives, those characters and their narratives all the way through the course. So they're doing the 10-step program of self-evaluation at the same time that you are. And you know, it really helps to have the narratives for memory and for engagement, and just to see the example of them working through the 10-step program and bringing and working out what's right and wrong about their investing and bringing themselves up to speed on the investment process. It really helps to be able to see that example to work out what you should be doing. So we have these narratives for that purpose. And then we also have a bunch of case studies. This one is about Steve and Rimmer, who are thinking about buying an apartment in the middle of the COVID-19. And this actually is about negotiation. This is about how to negotiate properly with the vendors, the sellers of apartments, with the real estate agents, with the bank, etc. Negotiation is such an important thing to get to right results. And so that's a small case, which really brings out important points about negotiation that we talk about in class. Now here you can see the class by class topics. Let me just flick through them. What we talk through, we get rolling in the first class, understanding lots of things and setting your goals. And then we are working through the course by looking at different asset classes. We spend a couple of classes on shares, on the stock markets. And while we're doing that over here, we are positioning you on the risk spectrum in the second week and working out what you're currently invested in the third week. And then we continue with the stock market and work out whether you're saving enough. And then we're into residential property and commercial property and fixed income, meaning bonds and corporate bonds and government bonds, etc. And then we're into risk management and insurance. Negotiating effectively is in class 8 as well. And then we get into financial advice and working with other types of advisors like mortgage advisors and accountants and the like. And then we finish up with structuring and tax planning, where Stephen Pryor and Brendan Gilly come to the class to answer your question. So we work through the course week by week. We're working through asset classes. That's the what. But we also have a series of videos, which is taking you through the where, the structuring and tax planning. And we're developing the investment process and strategy all the way through. And then we have week by week the 10-step program, which brings you up to speed on that investment process. So it's a very coherent thing, the course. And here it is, 10 Tuesday evenings, runs for 10 weeks. It is $1,200 plus GST. Obviously, that's per household for everyone in the household to use. And it delivers empowerment and better investment. Go to windlestone.com to see a full long description of the course, the information session. I think it's called the introductory session on the website. And you can enroll. And it's coming up soon. We have quite a lot of people enrolled already, and we don't enroll too many people, so that we have an interactive Zoom session. Hope you will have a look at it. Love to see you on the course.